Hello everyone. Majority of the Indian investors focus solely on the Indian equity share market and hence have to content with the facilities available to them there. There is nothing wrong about it, but because of the technological advances in the last few years, there are several other facilities which have opened up for the worldwide investors which have enabled them to get very good and consistent returns. And do not worry, I'm not going to talk about crypto. In this video, I'm going to share with you five facilities that the global investors have, but the Indian investors are missing out on. So let's get started. Before moving on, please read the entire disclaimer carefully. Okay, so the first facility that is missing for the Indian investors is the wider access to global markets and instruments. Most developed markets offer their retail investors easier, cheaper, and direct access to global stocks, ETFs, and other assets on international exchanges. In India, direct retail investment is constrained by the liberalized remittance scheme LRS limit set by the RBI, which caps the total amount an individual can send overseas per financial year. While routes exist like investing through Indian mutual funds or specific broker tie-ups, direct low cost trading in a vast range of global securities is not as seamless or extensive as in the US or European markets. Products like American Depository Receipts, that is ADRs, or Global Depository Receipts, that is GDRs, allow Indian companies to list abroad, but the mechanism for Indian retail investors to easily trade the foreign equivalents of global stocks within the domestic brokerage framework is not yet fully developed. Let me show you a couple of graphs to highlight the magnitude of the opportunities that Indian investors are missing on. So, this graph shows the largest 50 listed companies across the globe, and 33 of those 50 companies belongs to America, 5 belongs to China, and then couple of there are several countries with one each. As far as India goes, Reliance is the only company in the top 50 companies, and it is ranked at number 46. The market cap of Reliance is approximately $275 billion, dollars, whereas that of the largest company is around $5 trillion. So Reliance is only around 5.5% of the largest company. That means roughly 20 Reliance have to be there to become equivalent to the largest listed company in the world. Okay, now let's see another graph. Year till date returns. So this graph shows the returns in the year of 2025, calendar year of 2025, for the top 10 economies of the world. Indian market has given returns of only 3.50, and as you can see, it is the worst performing market in this year. All other markets have performed very well. USA, with the most uh, uh, talked about market, has given returns only of 15.50, still around 5 times out of or 4 times out of Indian market. You can see most of them has given returns in 20% ish range. China has given 37% and Italy has given 47% returns in the calendar year of 2025 till date. So you can see the magnitude of the opportunities that the Indian investors have missed on because of the unavailability uh, for them to invest, say, in the Italian share market. Now let's take a couple of examples as well. For example, a US investor can, through a standard brokerage account, buy shares of Nvidia, or say an ETF tracking the Euro stocks 50 as easily as buying an Apple stock. Indian investors, on the other hand, face significant hurdles, including LRS limits, complex tech filing, and a lack of direct seamless integration between domestic brokers and major global exchanges. This prevents easy, timely, and diversified access to high growth sectors or geographies not adequately represented in India. Let's take another example. Many US platforms allow investing in global bonds or specific commodities ETF like copper, platinum, palladium just with a few clicks. The Indian investors cannot invest in any ETF for copper, platinum, or palladium. They have to be restricted primarily to domestic equities and mutual funds. They miss out on the crucial diversification benefits and opportunities to participate in global economic trends such as the rise of specific Chinese tech giants or niche energy funds. Let's move on to the next missing facility, which is the robust and deep corporate bond market. Now, major developed economies, especially for example America, have a massive and highly liquid corporate bond market that often rivals the equity market in size and depth. This offer companies a reliable non-bank source for finance and investors a diverse, lower risk asset class. The Indian corporate bond market is significantly less deep, less liquid, and less accessible to retail investors compared to its equity market. Companies primarily rely on banks for debt. This limits alternative investment options for retail investors seeking stable returns and restricts the funding avenues for corporations. There are several platforms which have started providing investment opportunities in corporate bonds in India, but their liquidity is still a huge concern. So, for example, these are the few: Golden Pie, Grip, India Bonds, Bond Bazaar, Bid. So these are few platforms which allows investment in corporate bonds, but they still have a long way to go. Let's take a couple of examples here. A retiree in the US can build a bond ladder by directly buying small denominations of high rated corporate bonds, companies like Coca Cola, Microsoft, etc., with staggered maturity dates to create a predictable monthly income stream. The Indian corporate market is largely dominated by the institutional players. Retail investors mostly rely on fixed deposits or debt mutual funds. This denies them the ability to directly access higher, predictable, and tax efficient fixed income that a vibrant corporate bond market offers for capital preservation and retirement planning. Let's take another example. A small global investor can easily sell a corporate bond on the exchange well before maturity for instant liquidity if they have the need for an emergency cash. An Indian investor, on the other hand, due to the illiquidity and high minimum investment requirements, often face difficult exiting a corporate bond position before its maturity, locking up their capital and exposing them to higher liquidity risk. Let's move on to the third missing facility, which is the extensive retail short selling and borrowing facilities. In many developed markets, short selling is a commonplace activity for retail traders, providing a crucial mechanism for price discovery, liquidity, and most importantly, hedging. In India, retail short selling is effectively not permitted in cash market. While an investor can sell a stock they don't own by intraday short selling, they must compulsorily square it off by the end of the day. Unlike international markets, the practice of short selling for longer duration by borrowing shares through a robust securities lending and borrowing mechanism is primarily used by institutions, not easily accessible or cost effective for the average retail trader. Let's see couple of graphs. Now this graph shows the share of this securities lending and borrowing in India. The average daily turnover SLB is just 0.74% of the daily average daily turnover as compared to the world. Globally, around 5.66% daily turnover, average daily turnover is in SLB segment. So we have still a long way to go to basically catch up with the global markets. Let's see an example for this. A global investor believes a specific company is overpriced due to poor management. They can easily short sell the stock to bet against the company, providing crucial price discovery and liquidity to the market. For Indian investors, While institutional short selling exists in India, extensive retail short selling is limited or cumbersome. Indian investors are largely restricted to buy first, sell later approach. This limits their ability to hedge their long term portfolio, that is, protecting against market downturns or profit from bearish views on overvalued stock, severely restricting their directional trading strategies. And you might have observed this in the last 1 year. In the last 1 year, a majority of Indian investors' portfolio has not grown even by a percent. There are very, very few investors whose portfolio has increased in any value in the last 1 year. Let's now move on to the fourth missing facility, which is the fractional share ownership. Very important. Fractional share ownership is a popular facility in several global markets, allowing investors to buy or sell a portion of a single share rather than an entire share. Now, in the Indian markets, one must buy a stock in whole units, one share, two share, etc. This makes investing in high price stock challenging for small investors. Fractional share trading is not supported in the domestic market, making diversification difficult for investors with limited capital, a feature widely available in countries like US to encourage mass participation. Let's see a few of the companies. MRF, the price of MRF, one share of MRF is 1,58,000 today. Page Industry, 39,400 odd rupees, one share price. Bosch, 39,970 rupees. Yamuna Syndicate, 36,000. Then we have LSID Investment, 1,34,100 rupees per share. 3M, 35,950 rupees. So basically, you can see that because of the unavailability of the fractional share ownership feature, most of the retail investors in India actually cannot uh, buy any of these companies. At least those with who have capital less than the price of at least one share of these companies. Let's take an example as well. A single share of a company like, say, Berkshire Hathaway might cost hundreds or thousands of dollars. Fractional ownership allows an investor to buy a piece for it for as little as $5. Indian investors are forced to purchase stock in full units for high priced blue chip stocks, which can sometimes cost thousands and even lakhs, as we have seen here. This often means small scale retail investors cannot afford to buy even one share, or they have to deploy a disproportionately large amount of capital into a single stock. So this is something which can be done, I guess, quite easily and is and should be done as per me. Let's move on to the final missing facility, which is the longer or 24-hour trading sessions. Now, some international markets, especially those offering products like Forex and certain commodities, operate on an extended or near 24 hours trading cycle through electronic networks, accommodating a global investor base. Even standard equity trading hours in the markets like US are significantly longer than India. The Indian stock market operates on a fixed, relatively short trading day, typically from 9:15 a.m. to 3:30 p.m. India time for the equities. There is no extended hours or 24 hours trading facility for equities, limiting the ability of domestic investors to react to late breaking global news or trade in different time zones. Let's see a graph. So this graph shows the uh, trading duration of several markets across the world. Where is India? Here is India with 6.25 hours of trading allowed. Now we have China only 4 hours, Japan 5 hours, Hong Kong 5.5 hours. But check out the European markets. United Kingdom 8.5 hours, Germany 8.5 hours, European Union 8.5 hours, United States with 6.5 hours. But if we include the pre and post session, then American markets are open for 16 hours in a day. 16 hours. Okay. Uh, there is a Germany floor, which is basically the brokers directly walked in a physical. So it is not electronic as such, but physically they can trade for 12 hours. So the point is, 6.25 hours are extremely less, in my opinion. India is a working class majority country, with most of us are busy with their offices or their businesses throughout the day. So it would be very helpful if the markets open us from early morning and remain open till late night. That would help us a lot. Let's see a couple of examples to justify the basically the point against this short duration of market. An Indian company listed abroad announces its quarterly earnings, say at around 6 p.m. IST, that is the after Indian market closes. Global investors who are invested in those Indian companies have the time to react in after hours trading sessions. Indian investors must wait until the next day, that is 9:15 a.m., to trade. This forces them to bear overnight risk where they are unable to buy or sell to take advantage or protect against the news. This puts them at a major disadvantage compared to institutional investors who can often trade via other less transparent routes. Let's say final example for this: major global economic news like say US Federal Reserve's interest rate decision happens late in the evening. Global traders can adjust their positions immediately. The Indian market is prone to significant gap up or gap down openings the next day following overnight global news. Retail investors have no mechanism to execute a trade at the closing price, forcing them to take the opening price, which often results in lost opportunity or magnified losses. The best example, which I can give you right now, is the price of gold and silver ETFs. The gold and silver prices crashed late evening on Friday, that is after Indian closing hours. Now, Indian investors cannot do anything. They have to wait till Monday morning, and in all likelihood, both the gold and silver are going to open as gap down. Indian investor cannot do anything about it. But the global investors, because the rates of gold and silver plummeted afterwards, they can actually take the corrective actions, and the rates have fallen because of the hawkish or less chances about the rate cut in December by US Fed. Anyways, so to conclude, the Indian market is rapidly modernizing and addressing some of these gaps, but these differences highlight areas where major global markets offer greater flexibility, product depth, and accessibility. That is all from my side in this video. Thanks for watching it. Please like, share, comment, and subscribe to the channel. Goodbye and happy investing.